Hello guys, welcome back to my learning summary of managerial accounting. Here we are in the 11th meeting with the Prof. Roy Sambal, and today we learn about two things. We cover two materials. First is financial due diligence. So before that, we need to know what is due diligence. So due diligence is the auditor things or the report things that investigate by the companies, usually from the internal or it can be the external research of the company, to know the specific things, the specific report. There is also the instead of financial, there is also HR, there is also commercial due diligence, but today we focusing on financial due diligence. So it's all about the financial report or auditing things of the company. Usually this report is as a requirement of business merger. So when a company want to combine with others company, with to partner with merge each other, so they need to create these things first. So and also the major factor the companies this merger filed is because they're filed in this due diligence. So after we know that there's the due diligence, the understand of due diligence, we are trying to how to create the due diligence, right? So first we find out the requirement information, that the information of the company that is required in this due diligence. So after that we create the analysis, and then we do what the specific project for them next, and then we try to implement it, establish it as a report, a complete report of due diligence, especially for the financial area. So how to read this due diligence? First things, the tips to read this, you need to read the executive summary. After you read the executive summary, you will know, okay, this due diligence is about this. After that you will read the conclusion, and then the background, and also conclusion, the background, and then methodology, and etc. But the things that you need to read executive summary and solution, conclusion or recommendation. So the structure that due diligence needs, especially finance FDD needs, it's usually about the capital structure, working capital structure, assets, revenue and cost structure. So this is about due diligence. It's about report. It's about auditing thing. The companies need to use. They need to create to know the condition of the company itself, especially when they want to do the project with others company, right? So next things, this is the first session. So in the second session we learn about financial shenanigans. So we know that shenanigans is the word that we use to the action that's hidden things that in unpolite and ungood lah, is the bad things, but this is okay to do. So shenanigans is also happen in the financial things. There is a 7 deadly sins or 7 shenanigans financial usually do, especially when they do the report, or maybe for the due diligence or annual report. So the 7 financial shenanigans. First is about recording revenue too soon. So the company create report, the report use revenue, he established the revenue that not already received, but they just write it and they report it as a revenue, and then also recording because revenue, there is no things happen but there is no actual revenue, but there is a revenue, maybe there's a refund, but there is a revenue. And then boosting income with one times. This is like it could be like when company having a good income from where? It's just like, yeah. And then shifting current expense to the latter period. So this times the expense is usually actually being quite low instead, because the expense is adding in or include in the next period of time, and then availing to disclose all liability. So the liabilities is just like they try to cover it. So yeah, this is the 5 if it is negative things. But there is 2 things that usually it is a positive, it is good for the company, but it's include as shenanigans. Those things is shifting current income into next period, and also shifting future expense into these periods. So usually it's good, but the key answer is these things is need to use or is usually used for this new CEO of the company. So because we know that the the income and the expense of this session, especially of three or two first question for first and second quarter is created by the last CEO. So we need to move these things to the others. And yeah, this is good also to CEOs, the new CEOs, yeah, because we know that being CEOs, we need to lower the first. We as the starter things to make the companies good. Yeah, there is things, but we need to know why companies, what happened, and why the reason why shenanigans happen. Yeah, usually shenanigans happen because there is a bonus. When we create the good auditing report, the good annual report, there is a bonus for the boss. So yeah, we create this, and then for financing convenience, not financing covenant. When company want to asking for new money, fresh money, doing debting and etc. So this is very good because they need the lenders or the bank want a good report, right? The good financial condition. So they create this. There is also the fear factor and etc. But last things, I learned that the companies, there is a key signals of shenanigans. There's 10 factors, key signal that we can use. But first thing is a dishonest of management. So if we hearing the dishonest people, we already being like, okay, it just like stereotyping people, like judging people that it is. I will check it for twice later. It is, yeah, it's just so bad. And then there is the changing of the board of the director, especially financial things that, okay, it usually happen wrong. So this wrong thing happens in this company if the director being shuffle for the latest period of report. And then there is and then when the others analysis, financial analysis is just like the asset turnover is the inventory turnover is not really reliable with the income, and then, is this something wrong, like in this analysis in this companies, where this others inventory and etc. There's a lot of things. It is signal to you to know that this company is doing shenanigans. So that's it, guys. Thank you for watching. See you next week. Bye.